Back on a Monday, as Canada's housing agency warning over 2 million mortgage holders will face interest shock in the next 2 years. Here is money expert Rubina Ahmed-Haq, who joins us now for more on this. Rubina, good morning to you. And this new report from the Canada Mortgage and Housing Corporation says there's new analysis that shows the real pain of higher interest rates on homeowners.
Yeah, and that's coming in the next 2 years, like you mentioned. So many Canadians are up for renewal, especially if they have fixed rate mortgages going into 2024 and 2025. And so these would be mortgages that they would have fixed back in 2021 when interest rates were at rock bottom. And they will be, in some cases, renewing from a mortgage that was, in the mid twos into the mid sixes, maybe 7%. And so that is really going to increase their payments. They're saying those who have bigger mortgages, so more than $850,000 are the ones that are feeling it the most for obvious reasons because they've borrowed more money. The default rates are still very low, much lower than 1%. So they're not concerned about Canadians not being able to afford their homes, but this definitely could put pressure on Canadians just not being able to spend extra money because all your money will be going towards debt servicing.
Now, Rubina, this report from the CMHC also says Canadians are having difficulties with car loans and other credit products. What's your advice for anyone who may be in arrears?
Yeah, if you are behind on your car payments, it would be a good idea to call the financing company that you are associated with your car to see if you can get out of that lease and what that cost would be. Maybe if you're driving two cars, you could be a one-car family for a short term so that you could save that money, especially if you're in a car lease that's costing you maybe $1,000. In some cases, if you have a luxury car, that's how much it is a month. That is money that you could be spending towards other things that are much more necessary, like your mortgage repayments, grocery costs, housing costs, and you can call your bank if you're worried about making your mortgage payments. They always have an option of take a holiday from your mortgage payment. That helps free up some cash flow. It's really about focusing on cash flow and taking a good hard look at what you owe and what you could sell now to free up some of that money.
All right, up next, let's dive into these new numbers from StatsCan, Rubina, that says the recovery following the first year of the pandemic produced uneven income gains, with the top 1% of earners getting richer and the bottom half, Rubina, seeing their incomes actually drop.
Yeah, the top 1% in Canada, their salaries went up by up to 10% after the pandemic. And the bottom 50% actually saw their annual incomes dive by about $1,400. So you can imagine the impact that has on somebody who isn't making a lot of money to begin with. I mean, really, this is because of a lot of the pandemic emergency money that came to an end. So that money was no longer going into the pockets of those who could not work because their industry was shut down or their job was unsafe for them to be in person. So they were taking things like CERB or other emergency benefits that the government was handing out. And once those ended, they had to go back into the workforce. And maybe if they couldn't get the same hours or they couldn't make the same amount of income, they found themselves, not in the similar situation that they were in financially before the pandemic. Whereas those people who had office jobs were able to keep their jobs. And in some cases, especially those with high skills, were able to actually ask for increases in their wages because their skills were so highly sought after during the pandemic and after.
Rubina, we wanted to ask you about this as well. Canadian Tire recently announced a 3% cutback of their workforce. How surprising is this ahead of the holiday rush? And what does this tell us about the state of the Canadian economy?
So it's surprising when you see the headline because retailers usually ramp up their hiring during the holidays because more people are shopping. But then when you look at the situation that Canadian Tire is in, where they're trying to save some money, be more efficient, which usually just means cutting labor costs or laying people off, they've really become very technical too. So if you go on their app, you can now find that product that you need in the aisle, exactly where it's going to be. So they're really trying to pour more money into their tech tools so that it makes it easier for consumers to actually find those products, so they don't actually need customer service representatives to help them. This is another example of what we've talked about before called skimpflation, where you go into a store and you're really on your own now because they don't have as many people that they've hired and paid for to help you find the products that you are normally looking for with the help of a salesperson.
All right. Finally, I wanted to ask you as well about, what would a money update be if we did not talk about food prices and food inflation? And as a grocery code of conduct nears completion, Canada's largest grocer, Loblaw, now says, Rubina, they can't endorse it. Why do they believe that this could actually increase food inflation instead of reducing it?
They're saying that it's going to make it more cumbersome for them to deal with suppliers, and it'll be harder for them to bring suppliers up when they are slow on their end, and to say that that's the reason why they're having to increase prices. Now, this code of conduct, if you go to the website, basically they want transparency, they want fair pricing, they want increased competition, and that is all to bring prices down for consumers. The thing that's frustrating is that they're trying to avoid things like the bread fixing scandal or inflation when it's not valid, when you see inflation coming down but grocery prices are remaining high. I think consumers have a right to ask grocers, why is it that inflation is coming down but your prices are still remaining high? And it's even more frustrating to hear a big conglomerate like Loblaw say we're going to increase our cost by $1 billion. I mean, that can scare consumers to think, well, this may not be a good idea. But a code of conduct, it's not law. It's really something the grocers promised to do to increase transparency. Can only be a good thing for consumers.
All right, we're going to have to leave it there. Rubina, thank you so much.
Thanks for having me.